It is the year 1935, and to meet a national emergency, the Congress of the United States has charged the President with the responsibility of administering the work program and accounting for more than $4,880 million. It is to provide relief and work relief for 10 million unemployed Americans. Relief through great numbers of nationwide projects, through the building of hospitals, schools, libraries, playgrounds, through reclamation of vast waste areas, through reforestation and harbor improvements, through rehabilitation of great city slums, through construction of dry docks, shipyards, airports, through jobs for clerks, typists, and office accountants, for nurses, doctors, teachers, and writers, for actors, musicians, painters, sculptors, for carpenters, masons, plumbers, mechanics. Work, work, for all who would work. Great projects are started in 48 states: Maine, Alabama, Minnesota, New Jersey, Oregon, Texas, the Carolinas, Nevada, Kentucky, Rhode Island, Wyoming, and in the territory, all told, no less than 250,000, 250,000 projects. Mightiest task of its kind the world has known, the task of creating millions of jobs, the task of employing millions of men, the task of assisting millions of women. Where is the mind that is able to grasp it? What are the men who have to direct it, to see that these billions are properly spent? It's a step unheard of in American history, and someone, of course, will have to account. And like the father of his country, who in the darkest days of the birth of our freedom kept his accounts for the Congress with meticulous care, the President knows his responsibility. But how can he account for all that money? How can he tell where each dollar goes? How can he know it is honestly spent? How can he control the spending of others? At the end of the World War, Congress had provided a budget system, likewise an independent audit agency, the Office of the Comptroller General, but not an administrative accounting agency to exercise current executive control over the government's financial outlays. And so in 1935, with millions of men out of work, when Congress made available $4,880 million with a proviso that he rendered to Congress a report for his spending, a report within 10 days of the close of the year, the President met this gigantic demand by calling upon the Treasury of the United States for assistance. Upon that long-established department, logically enough, fell the task of creating a new administrative control system by giving the President the tools of management, of providing machinery to make it function, and of producing the President's report for Congress within the first 10 days of the new calendar year. For more than a century and a half, all government receipts and expenditures had been accounted for by the Treasury, but its accounting methods now were far from adequate, and for such a task as this, it was illy equipped. To account for these billions as Congress demanded, it would have to create an entire new system, a centralized agency of accounting control. The Secretary of the Treasury and his financial and accounting experts, among them the Director of the Budget, Mr. D.W. Bell, and the Commissioner of Accounts and Deposits, Mr. Edward F. Bartelt, discussed the problem, and as a first step recommended that the 80-odd federal departments and relief spending agencies be brought together to declare their several administrative needs. Approving, the President ordered a conference at which the various agency heads codified their views. There followed Treasury Regulation Number 1, approved by the President, prescribing the basic principles on which the Treasury accounting system was established, and implementing General Executive Order Number 7034 of May 6, 1935. It directed that accounting for relief expenditures be placed within the Treasury Department, and at once the Treasury began to set up a system of central accounting control to perform 4 major accounting functions. A system providing, first, control of this huge appropriation by congressional limitation as to classes or groups of project. Second, control of every detailed part of this vast program by presidential limitations as to specific projects, providing third, for examination of every payroll and voucher and other financial documents before payment so as to keep all expenditures legal and proper, and fourth, providing the President with a means for accounting to Congress on the expenditure of these billions, and with these steps to provide effective safeguards for every financial obligation and commitment, to speed up payments to workers, and to ensure prompt, frequent, and exact administrative reports. That was its task, a titanic task of mass accounting. During the many years the Treasury had been handling payrolls and vouchers, it had kept books by the conventional journal and ledger system only. Now, obviously, it had to re-gear itself, for it had to spread funds widely in every town and hamlet, and to render accounting and financial reports daily for agency and local representatives, monthly for project directors and federal department heads, every 10 days for the President himself, and at the close of the calendar year, that all-inclusive report for Congress. It had also to submit loan collection reports, cost analysis reports, warehouse reports, and unliquidated encumbrance reports, as well as reports by type of work, such as schools, roads, and bridges, by object of expenditure, such as labor, materials, and equipment, and by congressional limitation, such as aids to transportation and flood control. Also reports by states, and for each of the 80-odd departments and agencies entrusted with the expenditure of funds for relief. Its first step was to establish local accounting, dispersing, and procurement offices in 57 cities throughout the 48 states and outlying possessions. Speed was essential, and the orders to these branches were to forward their periodic records by airmail. For their quick assembly in Washington, up-to-the-minute accounting machinery was brought into use. And here, for the edification of those who are not accountants, let's have a brief explanation of the electric accounting system. The electric accounting method employs what is known as a tabulating card, machines for punching, for sorting, and for transferring the punched hole data from the cards to permanent record sheets in printed form. The tabulating card itself is basic to all that this method accomplishes. Now let us see how the system works for the Treasury. First of all, it reduces all names and other data to code numbers. Punched in the cards are such items as date, voucher, agency, county, state, type of work, object of expenditure, and congressional limitation. This for identification of each payment. In each case, the whole represents an alphabetical or numerical fact. Immediately the card is fed into an accounting machine in action. The latter automatically reads the meaning of the whole and sets it down in printed form. The holes in the cards cause mechanical adding and subtracting. And last, printing of the appropriate letters and figures on the report sheet. Next, it sorts the cards into particular groupings according to the kind of reports desired. Sorting is done at the rate of 400 cards per minute. The cards are directed to the proper pockets by electrical contacts made through the holes. The brush-like fingers of the sorting selector, by feeling their way over the punched holes in one group of code columns, sort payments by projects. Again feeling their way over the holes in another half-dozen columns, payments are sorted by department and agency. Other sortings separate payments by type of work done, such as schools, roads, and bridges, or by objects for which the money was spent, such as labor, material, and equipment, or again by states where the projects are located. Proper administrative control of thousands of projects carried on by many departments and agencies in scores of states requires means to analyze progress and results in countless ways. One day, results may be analyzed to determine whether each state obtains its fair share of assistance. Another day, they may be analyzed to see that the proportion of equipment and materials used does not overbalance that of employment of human labor. And yet another day, some new combination of figures may be used to tell whether production in the consumer's goods industries is being overly stimulated in relation to durable goods production. The simple brush-like fingers of this electrical sorter have made possible a revolutionary development in the responsiveness of government programs to detailed national needs. The first of the four major accounting functions of the Treasury's Emergency Accounts Organization, it will be recalled, was to control the limitations fixed by Congress for various classes or types of projects. This is accomplished, as the following part of the picture will show, by setting up in Washington the necessary overall controlling operations and accounts into which subordinate controls are dovetailed, and against which the individually approved projects are charged. Every dollar as allocated by the President has first to be measured against these limitations before credits can be opened for individual projects. Now to follow the steps taken by the Treasury in opening the various accounts maintained in the central and state accounting offices. Congress, as you have seen, had furnished congressional appropriation authority for setting up and maintaining the Treasury's conventional system of accounts and ledgers. But upon this traditional system is now superimposed the new emergency relief system of accounts, depending upon a brand new series of figure facts. First, a warrant is drawn by the Secretary of the Treasury, establishing in the Treasury's books the limitations fixed by Congress on the various classes of projects. But before the funds are made available, they are checked by the watchdog of the Congress, the Comptroller General. Within the limits fixed by Congress, the President is authorized to approve individual projects. But before the President approves the project, it is carefully scrutinized by the Budget Director. Now come the letters from the President, directing the Treasury to set up the project accounts. But wait. The Treasury warrant covering the project is checked by the Comptroller General to make sure that it comes within the purview of the Act of Congress. The workers, of course, are not interested in legal formalities. They are concerned about work. The Treasury is aware of that, too. And immediately, upon approval of the Treasury warrant by the Comptroller General, the funds are transferred by wire from the Treasury to every state and possession wherever needed. Confirming this telegraphic action come the letters written by the President to department heads approving projects. Upon receipt of these, the department heads issue authorizations. With these authorizations in hand, the Treasury state accounting offices set up control accounts and advise the state administrators. These administrators, in turn, send advices to the Treasury state accounts offices in the form of work allotments for commencement of specific projects. Each state accounts office now advises the individual project manager that money is available. From them, in return, it receives advance estimates or encumbrances for payrolls and materials. With these encumbrances approved, workers are hired and materials purchased. With a pay period completed, payrolls are prepared by the managers and vouchers issued by the Treasury State Procurement Office, both for examination by the Treasury State Accounts Office. As the next step, payrolls and vouchers are passed to the Treasury State Disbursing Office for payment, after which the checks to workers and vendors are promptly placed in the mails and speeded to their destinations. All along the line, from Washington to the worker, is red tape eliminated by the Treasury's new system. The second of the four major accounting functions of the Treasury's Emergency Accounts Organization is to control the limitations fixed by the President on expenditures for individual projects. These limitations are imposed by the Chief Executive after the Director of the Budget has carefully reviewed each project recommended by the departments and administrative agencies. The limitation applied to each project is fixed by the same presidential letter that authorizes its performance. And now, simply and clearly to explain this control on presidential limitations covering individual projects, let us liken the whole system to the functions and operations of a great dam. Its size and the general scope of its power or irrigation operations, however, are determined not by water, but by congressional appropriations. Back of the dam, money must be impounded to furnish power, and as its chief engineer, the Secretary of the Treasury must fill the reservoir behind the dam and control the money level. At all times, of course, he must keep the power level high enough. Amount and flow of Treasury cash to pay government bills are controlled and regulated, first, by appropriation warrant entries in the Treasury ledger in Washington. Second, by accountable warrant entries establishing checking credits on the books of the Treasurer of the United States, in the State Disbursing Office, and in the Federal Reserve Bank. At the dam itself are the main penstocks, or sluices, corresponding to the general limitations set by Congress. From its base, a vast network of canals spreads out, leading to subsidiary reservoirs. By these, eventually, as the picture indicates, each unit field is irrigated, as authorized and directed by the President. Let us now inspect the canals. Actually, they are the programs approved by the President. Control of the funds for these programs is exercised by Washington through its new system of administrative accounting control ledgers. Control of subsidiary reservoirs from which flow the funds for the unit projects is exercised through the new system ledger maintained in the State Accounting Office. In each State Accounting Office are the individual ledger accounts of all projects within the state. In all, 250,000 projects are thus controlled. Periodic totals, of course, are taken from the accounting records at vital points. These correspond to the readings taken at the main controls of the dam itself, at the small floodgates, and at the individual outlets to the fields. By such means is the President enabled to measure and control every phase of this immense operation. The third of the four major accounting functions of the Treasury's Emergency Accounts Organization is the pre-audit, or examination for legality and propriety of all vouchers and payrolls before payment. Administrative departments and agencies hire the workers and order the materials, and watch the performance of each project, but never are they allowed to handle a dollar of money. The Treasury alone handles and pays out the money, for it is the money the Treasury watches, and for which the Treasury makes its accounting. Now we are ready to consider this responsibility of the Treasury, the safeguarding of expenditures for legality and propriety, as well as for availability of funds. Before any project manager can hire a single worker or requisition a pound of material, he must get a green light or go signal from the Treasury State Accounts Office. Proposals for employment and for purchase of materials, known as encumbrances, are scrutinized by the Treasury. If legal and proper, they are recorded on Treasury books as obligations to pay or accounts payable. When returned to the project manager, a certified encumbrance or obligation, equivalent to a certified check in banking parlance, is his green light to go. This certified encumbrance guarantees to both worker and contractor that the Treasury has set aside the money needed to pay them. The summary total of encumbrances certified, furthermore, gives the Treasury advance notice of how large a covering balance must be kept in the bank. When the go signal flashes, each of the managers of the 250,000 projects puts his men to work. Meanwhile, the Treasury State Procurement Offices, on approved requisitions, let contracts and authorize delivery of materials by contractors. On every project, workers' time records are maintained. Likewise, delivery records. From these, payrolls are prepared by state headquarters of the administrative agencies, and vouchers are completed for transmittal by the Treasury State Procurement Office. Payrolls and vouchers, after final check and certification, go to the Treasury State Accounts Office for examination, and thence, after proper accounting, to the Treasury State Disbursing Office for actual payment. Here, a further means of safeguarding the government's money is employed. For just as a giant thresher beats away chaff from the grain, so does each State Accounts Office, before payment, remove every questionable item, preclude improper or illegal use of funds, and rule out expenditures for which the individual project allotment and disbursing officers' checking credit bank balances are insufficient. These safeguards eliminate all but a minute fraction of questionable items. The examination and safeguarding steps completed, payments are rushed through, checks are typed, numeral amounts are printed on them in raised letters. They are proofread and verified, then signed by a machine at the rate of 300 a minute. By another machine, they are inserted in envelopes and sealed at the rate of 72 per minute. Finally, Uncle Sam's postmen deliver them, an average of 6 million checks a month to some 3 million workers, and thousands more to contractors and vendors of materials. The total of these checks, issued over a 5-year period, if laid end to end, would encircle the earth at least twice, a distance of 50,000 miles. One further administrative examination of payrolls and vouchers is made after payment by the Treasury in Washington on behalf of the President. And a fourth and final post audit is made by the Comptroller General on behalf of the Congress. So thorough and precise are the first 3 safeguarding steps of the Treasury that out of every $1,000 spent, the Comptroller General's post audit to date has disallowed less than 2 cents. The last of the 4 major accounting functions performed by the Treasury Emergency Accounts Organization is the preparation of financial and administrative control reports. The purposes of the Treasury reports are, first, to enable the President to keep fingertip control of the program. Second, to assist administrators to watch their programs. Third, to aid the Secretary of the Treasury in financing the program. Fourth, to furnish an accounting to the Congress for the expenditure of the money. Fifth, to inform the public as to when, where, and how the money is being spent for their own welfare. The Treasury reports tell who spent the money, that is, which organization spent it. They tell where the money is spent, that is, in what states it was spent. They tell when the money was spent, that is, in what 10-day period, what month or year it was spent. And they tell for what the money was spent, that is, for what types of work or for what objects it is being expended. 2 types of accounts are summarized. First, the Treasury's conventional cash accounts, which concern only the government's financial officers. Second, the new administrative control accounts, which cover the management operations of the 80-odd administrative agencies. Summarizing the Treasury's conventional journal and ledger accounts is like balancing a pair of beam scales. For every weight on the debit side, there must be an equal weight on the credit side. At the close of each day, payroll and voucher disbursements are totaled, expenditures are debited, and cash is credited by equal amounts. At the end of each accounting period, ledger accounts are footed and totals extended on the trial balance statement. Upon receipt of the 57 state trial balance sheets in Washington, the figures are reduced by states to journal form, and the balancing debits and credits posted to the master ledger. After all 57 state trial balance figures have been posted, a grand summary trial balance is prepared covering the entire United States. This, in turn, is further consolidated or closed into one master balance sheet for the entire emergency relief program. The first balance sheet on such a comprehensive scale ever to be established in the accounting history of the federal government. Now let us consider the new accounting report procedure, as distinguished from balance sheet preparation. It opens with a payment of vouchers and payrolls. As fast as actual payments are made, copies of all documents are sorted into lots by type of document. The total of each lot of documents by type is computed on an adding machine for a double check, and the lot total posted on a lot control sheet. Then the documents pass to the electric accounting section. Here a tabulating card is punched for each document. The tabulated totals from these cards at the end of the day agree with the predetermined adding machine totals on the lot control sheet. The same set of cards can now be sorted and resorted into endless new arrangements or classifications. The setting of any new code number combination, like the turning of a radio dial, provides a rearrangement for analysis and control of work relief expenditures. Each day, new balances are tabulated. Here, fund balances are being checked. Here, cash balances. Thus, each day the Treasury knows, and project managers, state administrators, and Washington officials also may know, what balances remain for each project. At the close of each month, another rearrangement of tabulating cards provides a detailed statement of transactions by project. This resembles the familiar checking account statement which a private citizen receives monthly from his bank. With the balance from the previous month as the first entry, all transactions for the current month are footed, giving a new accumulated balance. 250,000 statements of accounts listing 3 million individual transactions are prepared in 3 days from the end of the month for the use of project directors. Also, at the end of each month, a further sorting of the cards produces special statewide reports for state administrators, giving them an overall picture of their own territories. Of two types, one report lists all unperformed contracts for labor and materials, a report of great value in keeping performance abreast of program plan. The second of these special reports furnishes each state administrator with a one-line balance statement for every project under his direction. These one-line balances, taken for the nation for a 1-month period only, would fill a set of books 20 by 30 inches in size and 8 feet high. These balances form the basis for further summarizations submitted by the Treasury to the Washington agency directors. At the close of each accounting period, financial summary tables and tabulating cards bearing administrative control summaries are flown to Washington, where independent tabulations are made within 72 hours, while a further sorting of the state totals provides the nationwide summaries for the President. Perhaps the most important tabulation of these cards is this report furnished the President every 10 days. It tells him if nationwide totals are within the limitations set by Congress. Also, through separate code columns included on the tabulating cards, it tells him, for his own guidance, of the type of work and object of expenditure. From each of these 3 viewpoints, the President can quickly scan totals for the entire United States. He is further provided with totals by states, by department and agency, and by accounting period. He knows whether the entire program is running ahead or behind schedule. He knows whether each state obtains its proper share of relief expenditures. He knows that the amounts going for wages are in proper proportion to the amounts being spent for materials. Never before has the Chief Executive of the United States had such fingertip control of current figures. We come now to the grand summation of all reports, the one the President submits to Congress. This report, though based on the 10-day summaries to the President, affords each senator and each representative the same overall view for his state that the Chief Executive enjoys for the nation. In this report appears the grand balance sheet. Another feature is a special analysis of recoverable assets, valuable in policing the hundreds of thousands of loans on crops and homes. Useful tables and charts are also provided, with explanatory text to assist members of Congress in their studies of the annual report. For this master report of 500 pages, the Commissioner of Accounts and Deposits and his staff lay plans far ahead. Only when every last detail of the report has been passed by a special staff does he approve of the final arrangement. And now we face the curtain as it rises for the greatest drama of the Treasury 12 months. The new year is at hand, and in the Treasury's 57 field offices, at the close of business on the last day of December, clerks and accountants spring into action to assemble the material for the President's report. That is their task, and every man does his utmost to make a new record. Every man does, for on the 3rd day of January, the state reports are speeding to Washington, and by the 4th, the last state report has reached the Treasury. 5 hectic days now follow in sequence. The 5th of January sees final manuscript assembly and the transmittal to the government printing office. The 6th sees the world's largest printing plant preparing negative photographs of all tables, charts, and manuscripts, and reproducing them as positive impressions on zinc plates, then locking the plates around the rubber blanketed rolls of high-speed offset presses. Throughout the night of the 6th of January, the presses turn out the President's report. January the 7th sees the stacking, the cutting, the folding, the pagination, the collation, the binding and trimming, the thumb indexing, and finally, the wrapping for delivery. By the morning of the 8th, the report is ready for the President's signature. The 9th of January finds the great labor of the Office of the Commissioner of Accounts and Deposits at an end. On the morning of the 10th, facsimile copies are on the desks of the members of Congress. Our legislators, especially Appropriation Committee men, constantly refer to this report, both privately and in debates on the floor. For the President, of course, it becomes an aid to executive control and budgetary management. For the Secretary of the Treasury, it means a new source of information for financial planning. And what a report it is when bound. The capstone of a truly great governmental achievement. And now, in conclusion, to summarize. In 7 years, through the Office of the Commissioner of Accounts and Deposits of the Treasury Department, some $20 billion have been dispersed. Since 1935, 330 million checks have been issued. Millions of dollars have been saved in discounts. Loans and collections have been efficiently handled. A vast work program has been expedited. Payments for relief have been tremendously speeded, and all at a cost that is absurdly small, less than 0.3% of all the monies which have been expended. Nor is this all that has been accomplished, for indirectly the Treasury has shown that one consolidated balance sheet can be produced for all government business, that figures for Congress can be compiled to meet every need of cost analysis. Such an achievement speaks for itself, and what it must mean to one and all is that better accounting means better government, and that in all things conducive to the nation's welfare, the United States of America marches on.